Hey everyone, this year in 2021, I am purchasing 15 dividend stocks. I actually own 50 different dividend stocks, but out of that entire universe, there are 15 in particular that I'm focused on right now. And so in the video today, I'm going to share this entire list of 15 dividend stocks. These are amazing dividend stocks. And in fact, I want to pause right now. Please go ahead and smash that like button. And when you're done, check out the description below and also the pinned comment, because you can download the entire list that I'm sharing today and follow along at home. And so if you were watching my last video, you'll know that I went through an entire framework, an entire flow chart that really outlines how I approach dividend stock investing and how my dividend stock portfolio is comprised of various different types of stocks. I have stocks that are foundational, that form the base, that are bond-like dividend stocks. I have core stocks that are really robust, strong, world-class brands that are growing steadily and not going anywhere. I have ancillary stocks, and I have the high growth portion of my dividend stock portfolio. I even have some speculative investments as well. And so the video today, I'm actually going to take that flow chart and I'm going to turn it into something more concrete, because you'll see today that in 2021, I'm actually purchasing stocks that are in various different categories throughout my dividend stock portfolio, but I'm weighting very heavily this year towards that growth segment within my portfolio. So I have a lot in store this year, everyone. So before we even get started today, don't forget to subscribe, because I have a lot of cool videos on the way. And let's get started with an exciting dividend stock video. Welcome to PPC Ian. This is Dividend Stock Investing for everyone. All right, everyone. So in the video today, I want to start with the boring stuff and get to the more exciting stuff as the video progresses. And so as you can see on the screen right now, there is a segment of my portfolio that is dedicated towards bond-like dividend stocks. These are dividend stocks that are growing pretty slowly, but they provide substantial short-term dividend income cash flow that can be used to pay bills, or it could be used to reinvest into quicker growing dividend stocks, or even the slow growing dividend stocks as well. But typically what I'm doing these days is I'm taking cash flow from these bond-like stocks and reinvesting it in the quicker growth dividend stocks. Or I'm just using the cash flow to pay some of my bills. So as you can see on the screen right now, I want to highlight first two stocks that I'm buying in this bond-like category this year. And those two stocks are PPL Corporation, ticker symbol PPL, and Altria, ticker symbol MO. Now, one of the first things I want to point out is I do use this color coding on the left-hand side of the screen. Yellow is the same color that I used in my flow chart to represent these bond-like dividend stocks, and green is actually the color that I used to represent core stocks. Now, Altria gets a yellow and a green because it's in between the bond-like stocks and these kind of more core stocks, if you will. So it has yellow and green next to it. But the purpose of these colors is to allow you to compare what I'm sharing today, again, that you can download in the description below, to what I shared in the last video, which I'll also link to in the description below if you have not seen it yet. Now, as you can see on the screen right now, I am allocating 10% of new capital deployed towards these bond-like dividend stocks. So this year I will be buying these stocks, but also I will not be deploying too much new capital towards these stocks. Now, In an effort to keep the video on track today and to optimize your time, I am not going to go through every metric, but you can see in kind of this light, say, a beige color, I do have certain metrics highlighted that I do want to cover. So with PPL Corporation, what I really want to cover is that the 2020 PE is an 11.63 and the 2021 forward PE is an 11.44. So those PEs are really low, price earnings ratios. The starting dividend yield for PPL Corporation is 5.9%, so a very respectable starting yield. And the market capitalization of PPL Corporation is only $21 billion. One thing that you'll see strategically this year is I am focused on smaller companies. I want to focus in my dividend stock portfolio on growth this year. And one area of growth is with smaller companies. A smaller company, oftentimes, it is the type of company that can exhibit more growth because it's just the law of numbers. As numbers get larger, it's more difficult to continue to grow, whereas smaller companies oftentimes have opportunity to grow quicker. Now, obviously, PPL is not a high-growth company. It is a bond-like company, but I highlight the market cap nonetheless because it is a strategic focus of mine this year to focus on some of these smaller market caps. Now, to be fair, as we've seen in recent years, some of the largest companies are the ones that just keep getting bigger. So it's kind of contradictory to what I just said because some of these really large companies like Apple, for example, which I own, which I will be buying more of this year most likely. It's on the list today. I'll get to it later. Obviously, that's a huge $2 trillion market cap company, but and it just seems to keep growing. But that being said, historically speaking, smaller market cap companies have had, in my opinion at least, a lot more opportunity to grow just because they're smaller companies. And so with that, I want to talk about Altria really quickly. Altria, Thug Life Investing, Sin Stock that I own. And Altria right now, it's just out of favor. And so obviously this is a company that offers not only a bond-like quality, but it also offers some growth as well. And so that's why it's yellow and green. It's one of these rare cases that borders two categories where you get a really high yield, but also a huge opportunity for growth as well, especially in Altria. I think there's opportunity for them in the cannabis industry. I think there could be a lot of opportunity in that industry for them over the long run. And so with Altria, what I want to highlight on the screen right now are a few metrics. The 2020 PE is a 9.43. 2021 is an 8.96, and so it is trading at a bargain basement price. I just may have to go out and buy some Altria right away because I don't know how long it will be at these prices, although it has been in this range for quite some time. I love the 8.3% starting dividend yield, and I love the fact that the 5-year dividend compound annual growth rate on average has been 8.8%, although I don't know if that will keep up because the payout ratio is up towards 78.7%. That being said, I love to see the fact that it has a high yield, a high dividend growth rate, and some promise in the future. I think a lot of people have written this company off, but I think it has an opportunity to be more than just the bond-like dividend stock that it's being traded at right now. Anyways, I don't want to spend too much time in the video today on these stocks because it's just not the core focus this year. But that being said, I always like having bond-like stocks in the portfolio for the current cash flow because I do use it to pay bills and for the opportunity to use that cash flow to selectively reinvest towards stocks that are higher up on the food chain in my portfolio. And so with that, I want to go to my core stocks, my ride or die stocks, if you will. Check it out on the screen right now. And so core stocks is where I was really focused last year in 2020, although many of these stocks now have rallied quite a bit. And that's why this year I'm only going to be deploying, say, 10% of new capital into these core stocks. Now, these are guidelines, if you will. I may end up spending more money, deploying more money into core stocks. We will see what happens throughout the course of the year. Although as it is right now, about 10% seems right just based on pure valuations. I don't see a lot of value in this basket of stocks right now. But that being said, things might change throughout the year. We shall see. But right now, I have it only allocated at 10%. And so let's keep going. And so one of the things that I did is I went through all of my core stocks, and I also just started looking at which core stocks I've invested the most money in. which ones I have deployed a lot of capital in, especially recently. And so anything on the list today per category, they are actually in a stack ranked order. These are in an intentional order. And so as you see on the screen, all the way on the left, I have Kimberly-Clark first. Kimberly-Clark is first because it has been a few years now since I've been deploying major money into Kimberly-Clark. Yes, I did put some money into Kimberly-Clark in 2020, but I didn't go really heavy in it the way I did in StarBucks and 3M, for example. And so I want to show Kimberly-Clark, makers of this Kleenex brand of tissue, some love. I think it's trading at a really attractive valuation now. And so as you can see on the screen, some things I want to highlight with Kimberly-Clark is that the 2020 PE is at a 17.19. The 2021 PE is at a 16.86. And the dividend yield is a respectable 3.3%. Payout ratio is only at 55.9%, so there's room to grow that dividend. And the compound annual growth rate on this thing is not too high. It's only at 4% on average per year. But what I do love about Kimberly-Clark, as I alluded to earlier in the video, is it does have a smaller market cap, which I do highlight on the screen as well, at the $40 billion range, $44.78 billion market cap. There's a lot of room for this company to flourish and grow over time, and we all know that toilet paper and tissue, Kleenex, is so important to all of us. And so Kimberly-Clark, it's not a very quickly growing company, but it is growing a little quicker, I would say, than some of these bond-like stocks such as PPL. Now, obviously, Altria, jury is out. That may be growing quicker than Kimberly. That's why it branches the two categories, or it bridges the two categories. But generally speaking, within my core stocks, Kimberly-Clark, it's a steady Eddie company, but it is trading at a really reasonable valuation with a great starting yield. And so it's one of those sleep well at night stocks. Let's keep going. And so next up on the list after Kimberly-Clark this year within my core stocks, again, which is only 10% of new capital deployed this year, is the Coca-Cola Company. And so Coca-Cola Company obviously is such an iconic brand. They make Coke, Diet Coke, all of these amazing beverages, and I especially enjoy the fact that they did acquire the Costa Coffee franchise brand of coffee shops, which is really popular in Europe, especially in the UK. And so I really like the Coca-Cola Company. I want to go through a few metrics, but before I even do that, one of the reasons that I'm attracted to the Coca-Cola Company right now is I'm just going after some stocks that I haven't deployed a lot of money into in recent years. And so one of the things, just as a general takeaway from the video, a thought exercise is to look at all of the stocks you own. And if there are certain stocks that are in your portfolio that you haven't given much love to lately, look at them. It doesn't mean that they deserve or warrant more love or more money deployed right now, but some of them might. And when I looked at the Coca-Cola Company, especially as the stock price is going down a little bit right now, that's something that I felt like, hey, I'm not going to put a ton of money into it. I already have a lot of money in it. But that being said, it deserves a little bit of love. And so with that, let's talk about Coke. And so as you can see on the screen, there's not anything really that I highlight too much with this one, because honestly, the PE ratio is high, but I would say the PE ratio is always high for this company. And this one does kind of break the trend in that it has a $208 billion market cap. But the one thing that I like a lot is that the starting dividend yield is 3.4%. And so 3.4% is a solid starting dividend yield, especially in this low interest rate environment. This is a company that is growing its dividend over time. It's not growing it super fast, but it is growing it. And so I like having core stocks like Coca-Cola in my portfolio. And now, am I getting rich overnight with companies like Coca-Cola? No, I am not getting rich overnight with Coca-Cola. I will talk about the companies in my portfolio that are fueling growth later in the video today. Again, as I mentioned, I'm starting with some of the more boring stuff and getting progressively more interesting throughout the video. So let's keep going. Check it out on the screen right now. What you see next is Johnson & Johnson. This is my number one favorite dividend stock of all time. The PE ratio is a little bit higher now because it has been rallying into that $162 range. This thing was trading forever in the 140s, 150s, and now finally it has surged in stock price. That being said, I do believe the PE ratio in 2020 of 20.32 and the 2021 PE of 18.11 still are very reasonable in the greater scheme of an overvalued stock market right now. Starting dividend yield is a little low at 2.5%, but I like the 5-year compound annual growth rate of 6.1%. The way I look at Johnson & Johnson is there's nothing more important out there than our health. And this is a mutual fund of sorts in the healthcare industry because they have such a broad sweeping portfolio of healthcare businesses under their umbrella. And so J&J, it's my number one favorite stock. I'm always going to be buying a little bit of that each year. Even though it's rallied up into the 160s, I still feel comfortable there. And I'll just keep adding to it. And so with that, I want to move on to the next stock. Check it out on the screen right now. I want to talk really quickly about Starbucks. I added a ton of money to Starbucks last year. And so honestly, Starbucks, there's really not a lot of numbers to highlight other than that 5-year compound annual growth rate, which is 17.6% on the dividend. On average, over the last 5 years, Starbucks has grown their dividend per year by 17.6%. That is simply staggering. Now, will that be able to continue in the next 5 years? Probably not, but if it's anything above 10%, I will be very happy with that. Now, this thing is priced to perfection. Am I going to be buying a lot of shares? No. Why did I put it lower on the list? Quite frankly, because I put a ton of money into it last year when it was trading a heck of a lot cheaper than it is now. That being said, there's just something about Starbucks. Investors out there say you should not get emotional about the companies that you own. I get emotional about every single stock that I own. I look at them as just prized possessions of mine. And I look at it that way because I buy and hold forever. I can only hold something forever that I have an emotional attachment to. Now, obviously, I only invest in companies that are sound financially, that are world-class companies, that are the best of breed companies. But that being said, yes, I do have an emotional connection to the companies I'm talking about today. And I actually look at that as a good thing. But anyways, I will be buying some Starbucks most likely throughout this year, just out of force of habit, because last year I was buying it almost every week throughout the year, and especially when it was at much lower share prices. But it's just kind of a force of habit thing. It's a good way to start off the week. Now, another bonus tip, I bought some Hormel stock today. I'll talk about Hormel Foods later in the video today, but I bought it because it's well, actually, today is not Monday. It's Tuesday because Monday was a holiday this week, but it's the first trading day of the week. And I always found that starting off the week on a positive note by buying a tranche of one of my favorite dividend stocks is a great way to set my mind right for the entire week. And so that's just another tip for everyone at home as well. Consider that ongoing dollar cost averaging and starting off the week on that positive note. It's always worked really well for me. So let's keep going. I want to talk about 3M next. 3M I list last because I have put so much money in 3M last year, and I feel like now it's rallied up quite a bit. That being said, the PE ratio for on a 2020 basis is still in the 19s, 2021 in the 17s. Starting yield is a juicy 3.5%. 5-year compound annual growth rate on that dividend is a nice 7.5%. So even though I put a lot of money into 3M, I still believe it's a really reasonable value here. And so I'll probably be adding more money to 3M in 2021. That being said, I want to share with all of you another hack. One of the things I've been doing recently in my stock portfolio is I've been sorting my positions in reverse order of the amount of money invested. And so I'm listing the ones at the top of my list first that have the lowest amount of money invested, and the ones with the most amount of money I've put in towards the bottom. And so stuff like 3M, now that I put in a lot of money, starts ranking lower on the list. And it's just a hack. I haven't historically looked at things this way, but one of the themes this year is I'm trying to allocate money towards those stocks that haven't gotten quite as much love in recent years, especially the ones, of course, that are on sale, that are a reasonable value. And I'll get to some of those throughout the video today. I haven't gotten into too many of them yet. Maybe PPL Corporation is a good example. That one hasn't gotten too much love, and it deserves some love because it's trading at a PE of 11. And so with that, one thing you'll notice is what's not on the list. One of the things that's not on the list is PepsiCo. Now, PepsiCo makes this bubbly water, and if you haven't tried this, this is a really good sparkling water. I love it. I go through so much of this and that La Croix brand every single day. Oh my gosh, I'm probably up to about 3 cans a day. Hey, I'd much prefer to be drinking water than pretty much anything else other than coffee. And so, but seriously, why isn't PepsiCo on my list this year? I have a lot of money in Pepsi, and Pepsi's a snack food company. Yeah, they make the water, but mostly what they do is they're in the snack food category. And I have a lot of snack food companies on my list that I'm going to be talking about a little bit later. And so I don't want to be too overweight in the snack food sector right now. And quite frankly, the companies I am deploying money into that are in the snack food space, those companies are growing a lot quicker than Pepsi. So that's what I'm focused on this year, because I'm focused on growth. And so I've only gotten through so far 20% of the money that I'm actually deploying this year. So again, I'm going in reverse order, but I got to start with the base and build up to the more exciting stuff from there. And quite frankly, the reason I start with the base is a lot of you out there are just starting out with dividend investing. A lot of people out there wonder, how do you build a foundation of a stock portfolio? Now, I'm only speaking to my personal situation, but what's always worked for me, speaking just to my personal journey, is starting with the base, starting with the foundation and building up from there. And so that's why I like to start in this order. And it's not always very exciting building the base, but it's always something that's treated me well in my personal dividend stock investing. But obviously, there are many different strategies out there for different investors. So I want to move now to the ancillary positions. These are positions that are ancillary to my core positions. They're not always the fastest growing stocks, but they're smaller companies. They're not quite making the cut into my core favorite ride or die stocks, but they're very valuable team players as well. Every stock in my portfolio plays a role. So let's talk about some of those. So let's keep going. And so what you see on the screen right now, first and foremost, is that I will be putting 20% of my money into ancillary stocks. So here we go. Now we're up to about 40% of money deployed this year. And you'll see some color coding here. I have green, but I also have the purple. There are certain stocks in this ancillary bucket that really bridge the gap between green, kind of core ancillary, into high growth. High growth, the color for high growth is purple. Now, in my other chart that I shared in my last video, the purple was a lighter shade of purple. But anyways, this is the purple you get today. But you see there are stocks on this list like Honeywell and Apple that, yeah, they're kind of core ancillary type stocks, but they're also high growth stocks. And so I'm excited about those because they bridge the gap between those categories. And a big focus of mine this year is on high growth. And so with that, I want to talk about first the Campbell's Soup Company. And so for those of you who have been around here a while, you've seen this before, but if you're new, this is what Campbell's Soup is all about. They are a snack food company. A lot of people think it's a soup company, and they are, but where they're even bigger than soup is in the snack food category. And if there's one category that I love investing in, it really is this snack foods, because all of us enjoy snacking on these delicious goldfish and other treats throughout the day. And so with that, check it out on the screen. Campbell's Soup is a company I truly love right now. This company is a total turnaround play. And now that they've successfully turned around their business, I believe the market has totally not realized their value just yet, creating an opportunity for investors who are able to move quickly. I've been buying a lot of it recently. I'll be buying a lot more of it. It's trading at a PE in the 15s, and so that is rare in this day and age. The dividend yield is at 3.2%. Payout ratio is below 50%, so there's a lot of room to increase that dividend. And market cap is only $14 billion. I love this company. I love this company for 2021, and I'll probably be going pretty heavy in Campbell's Soup this year. It may become not so much of an ancillary position. It may move. Maybe it'll never be a core stock for me, but in terms of money I've got in it, it might get up there towards a core stock. So we shall see, but I'm excited about that. Let's keep going. Next one on the list is another food company. This one is not so much snack foods as it is just kind of staple foods. They're also in the high growth pet food category as well, though, is General Mills. General Mills is trading at a PE even better than Campbell's in the 14s. And dividend yield is 3.7%. Payout ratio is just over 50%. There's a lot of room to grow that. and the market cap is 34 billion. And now if you've been around here a while, you've seen some of these props before. I know they're probably getting tired, but I've got to show the Annie's mac and cheese. This mac and cheese is really good, and it's an affordable light meal if you're looking for a quick lunch just on the go, or when you're sheltering in place, working at home. There are many days where I don't have any time for lunch. I'll just make one of these really quick, and it's a frugal dividend investing way to enjoy lunch, along with a bubbly water from my beloved PepsiCo. And so I want to keep going. Check it out on the screen right now. Next one on the list is Honeywell. Honeywell is one of those stocks that comes up at the top of the list when I reverse sort in terms of money deployed. I haven't put much money in this thing, and it's just gotten away from me, and now it's trading at a really high PE in the 29 range, 2020, 26, 2021. There's not much I can even highlight on Honeywell other than the fact that they've grown the dividend over the last 5 years on average by 9.3%. I will be buying Honeywell stock this year because I've come to the realization that I have a lot of short-term needs in terms of cash flow, and those are served by the base. Those are served by the core. Those are served by all the great values I bought in my dividend investing career to date, which has been over 20 years in length. That being said, I'm looking out towards the future. This is a year of expansion. This is a year of looking towards the future. I'm looking 20 years out, 30 years out, 40 years out. And as I look towards the future, yeah, some of these companies like Honeywell are expensive now, but also these are the companies showing the growth. And I know that companies can grow over time, can also grow their dividend over time aggressively. And I know companies that can grow the dividend aggressively over time can give me a huge yield on cost, and future generations in my family a huge yield on cost in the long run. And so, yeah, Honeywell's expensive, but given my really long-term horizon, it's the type of stock that falls right into my wheelhouse of prioritizing growth stocks this year. So yeah, it's an ancillary position, but it's kind of half ancillary, half high growth. I'll be buying it, and I'll be buying it even at these expensive prices, but I sure wish I bought some last year at the deeply discounted prices. It is one of the ones that got away from me. Now, check it out on the screen right now. Apple. I am such a fan of Apple because I use Apple products every day to do my job and to produce these videos. And so Apple is an ancillary stock. It's also a high growth stock. It's not cheap. It's trading in that same range as Honeywell. 31.88 for 2020, 29 for 2021. I don't have anything really to highlight here other than the fact that the dividend is growing at 9.5% per year. And quite frankly, that payout ratio is really low. So there's a lot of room to grow the dividend. Now, is Apple cheap? No, it is absolutely not cheap. Is Apple a small company? No, but I would say this is one of those companies where it's a winner takes all. And certain companies, man, especially in this tech space, sometimes it's good to go with the big ones because it's a winner takes all mentality. I don't foresee anyone displacing Apple. And I am so fortunate that I bought Apple a few years ago when it was really cheap. I'm up a few %. I'm doing really well on it, but I sure wish I put more. But it's never too late with my outlook so many decades into the future. This is one of those high growth companies that I think will keep expanding into ancillary verticals, related verticals. They may even be making an electric vehicle. And so I'll be adding more to Apple this year, but I'll be cautious. To be fair, I am a value investor. I do like to buy value. Honeywell and Apple are not on deep discount value. They're not even fair values. They're overvalued. So I'll be treading with caution and dollar cost averaging and not putting in too much. But brick by brick, I like to make progress in the right direction. It doesn't have to be too much, just baby steps, a little bit at a time. Let's keep going. And so next one on the screen right now, the last one in these ancillary stocks is Chubb. Chubb is just an insurance company. I'm surprised it's trading as high as it is, given that it's a property casualty insurance company, and who knows what the future holds for the types of properties they insure. That being said, I think these properties will always be around in some form or another, and so they will always need to be insured. The PE looking forward to 2021 is a 13. Honestly, though, the insurance sector, it's always kind of in this type of PE range, so I don't really see it as undervalued. I'd see it as fairly valued. It has a payout ratio of only 45%, slow growth on the dividend. Chubb, honestly, is not get rich quick overnight. It's not even keep up with the market. It's not even going to keep up with the S&P, but it's a sleep well at night factor company, and it's one of the only companies I have in the finance space. It's the only company I have in the insurance space, and so it's just kind of, so one of my subscribers put it really well once. I'm gonna leverage this quote that one of my subscribers gave me, and I think this was like 2 years ago when they said this to me, or a year and a half ago. Chubb, it's not very exciting, but it's kind of like at dinner when you're a kid and you're kind of like just eating your greens, you're eating your vegetables. I actually really like vegetables as an adult, but you know, a lot of kids, they don't like eating their greens, they don't like eating their vegetables, but you know it's really good for them. And Chubb, it's kind of like that. That's what the subscriber told me. And I kind of agree. It's like, yeah, it's never fun to buy Chubb, but it's one of these things where it's like, yeah, I'm just eating my vegetables. It's kind of good to have that in the portfolio. It's a good sleep well at night, diversification play. And I just haven't put much money in it, so it needs a little bit of love. It's not overvalued the way Apple and Honeywell are, but it's not undervalued. It's kind of fairly valued. So, hey, I'll put a little bit of money in. And so far I've gone through the base bond-like stocks, 10% of my money this year. I've gone through the core stocks, 10%. I've gone through the ancillary stocks, 20%. So we're up to 40%. But here's where it gets really exciting. This year for me is a year of high growth investing. I am really focused this year on adding a little bit of growth to my portfolio. And so I want to talk about that now. Let's talk about the high growth stocks. And so the first high growth stock that I want to go through today, all of these are in the purple category. The first one is Utz Brands Inc. And so Utz Brands, unfortunately, I didn't bring my prop today, but I have a bunch of their chips. Not so many left, though, because I honestly ate all of them. But Utz is a smaller company. It's growing really quickly. I'll link in the description below. I just did a video on it. It just went public last year in 2020 through a SPAC, and I did a whole video on it, so you can learn more through the description below in that linked video. But this is a very fast-growing company. It is a richly valued company. But I also think the valuation is a bit misleading on an EPS level because there is a lot of depreciation going on because they're growing through acquisition. And so anyways, Utz Brand, I think this is a really solid company that is going to potentially provide a substantial yield on cost looking out, say, 10 or 20 years. And so I don't want to get into it too much more than that. Although, as you can see on the screen right now, one of the things I do want to highlight with Utz Brands is the fact that their market cap is only $2.62 billion. $2.62 billion is one of the smallest companies in my portfolio. It gives a lot of room for growth. So let's talk about Hormel next. Hormel makes Spam, also Skippy peanut butter, all kinds of delicious meats, salamis, all kinds of those types of products. And I bought Hormel recently. This is an addition that I made in 2021. This year, I'm not scared to add more stocks to my portfolio. I own 50 stocks, but quite frankly, it's more like I own 47, at least in my mind, because 3 of the stocks I own are spin-offs. Viatris got spun off by Pfizer. Otis and Carrier got spun off from the old United Technologies, which is now Raytheon Technologies. And so 3 of the companies I own are spin-offs. And so I really kind of only bought 47 stocks, but I do own 50 of them. So at least I fool myself that way. But what I'm saying is, even though I just bought Utz, Hormel, Utz I started 2020, Hormel 2021, Church & Dwight, which I'll talk about next in 2021, I'm still kind of in my mind at 47, so I feel fine adding 3 more. I'm not going to add 3 more this year, but maybe I'll pick up another 1, maybe another 2. We'll see. I'm not against expansion this year, especially if it brings high growth element to my portfolio, a little bit more high growth than I've had historically. I'm happy to do it through expansion. So let's keep going. And so Hormel, honestly, I don't highlight a lot because it's expensive, but what I do highlight is the payout ratio is only 55%, so there's room for them to increase the dividend. And what I highlight is the fact that the dividend growth on average over the last 5 years is 11.1%. And so this company is growing the dividend really quickly, and the whole purpose of this high growth bucket is I don't care about high growth in terms of capital appreciation. It's nice, but because I never sell, capital appreciation doesn't really matter to me. But when I talk about high growth, what's more important to me is the fact that the dividend is growing fast. Because I know that, yeah, Hormel's dividend right now is in the 2% range, but over the course of 20, 30 years, if they keep growing the dividend at the rate they are, my dividend yield on my cost is going to be huge. It could be over 20% for all I know. And so that is the magic of dividend growth investing. And that's what I'm talking about, high growth. Although they kind of go hand in hand, that I also believe because Hormel is growing kind of quickly, the stock price will probably follow, and it probably will have some nice capital appreciation. And I look at that as icing on the cake, but certainly it's not my top priority because I never sell. I invest for the cash flow exclusively, because cash flow I can use to pay my bills without tapping into the golden equity of the portfolio. I just can't do it. It's a line I can't cross. I can't do it. And so let's keep going. Next one is Church & Dwight. Church & Dwight makes all kinds of products in the consumer packaged goods space. Hormel's in foods. Church & Dwight's more in products. They make like OxyClean and Arm & Hammer. They've got the Waterpik brand. They got the Trojan brand. So they got all these great brands. And Church & Dwight is really expensive. But I don't mind paying up for quality, paying up for high growth. Short-term dividend yield, it's only 1.1%. It's not going to help me right now, but the payout ratio is only 34%. There's a lot of room to grow the dividend, and the dividend over the last 5 years has grown by 7.5% on average. And market cap is only $21 billion. So actually, all three stocks, as you can see in this high growth category, have smaller market caps. And so I'm really excited about that. Now, I expect this year to deploy 55% of new capital in this bucket. So a lot of my new capital being deployed this year will go into these three high growth stocks. And as you can see on the screen, I do have a fourth placeholder. Who knows what it will be? I'll tell you, I've got this one on my mind, but I'd have to be kind of crazy to buy it at this price, because WD-40 Company is really expensive right now, but I'm feeling kind of crazy this year. You know, it's a new year, clean slate. You know, things are looking good. And so who knows, maybe I'll add some WD-40, but this is the kind of thing where at these prices, to make money on it, in terms of yield on cost and getting value just on a kind of PE ratio on cost basis, I'm looking probably like 30, 40 years out. And so it's a next generation in my family type of thing. But, you know, it's a really cool company. I've reviewed it here on my channel before. I'll link to that review in the description below. But who knows what the fourth company would be. Quite frankly, if you have a company that you want to share with me, I'd love to consider it in the high growth space, especially. Put it in the comments below. That would be really cool. And so with that, let's keep going. What else is on my roadmap this year? So I have speculative investments. Like I said, sometimes this would only be 5% of new capital deployed this year, but sometimes I will buy a more speculative investment. If you have any good speculative investments, put it in the comments section below as well. But the mindset this year, the mind state for me is towards the top of my portfolio. I've got the base figured out, the core, the ancillary. Now I'm in kind of the high growth and speculation just a little bit. And I've gotten lucky with the speculation over the years with Bitcoin, for example. But put in the comments below what you think about that. And so with all of this, now you have it 55%, well, actually 60% in high growth and speculative, 40% in everything else. But of that 40%, quite frankly, there is some stuff in that ancillary bucket that I would consider high growth, like Apple and Honeywell. And so I'd love to hear what you think about my strategy. If you like my strategy, smash that like button and share what you think in the comments below. If you do not like my strategy, also smash that like button and share in the comments below why you don't like the strategy. With that, I want to share on the screen really quickly a summary of what I've been discussing today. And so in terms of summary, just take it in. I don't want to repeat myself because I believe I have touched on all of these points throughout the video so far. And so I don't want to repeat myself in interest of your time. And so with that, I have one thing I want to do before I close out today. I have a Patreon, and on my Patreon, patrons have exclusive access to bonus content there. I have a lot of bonus videos, and I even have some really cool analyses that I've shared there as well. We have over I think it's like 115, 116 patrons over there right now. And so feel free to check that out if you're interested. It's really awesome. You unlock all the bonus content right away. But one of my patrons asked some questions, and I want to answer those very quickly in the video today before the end. And so check it out on the screen right now. The first question, and I'm going to paraphrase to save us some time, but as you can see, this is a European investor who does not live in the United States. And the question really is about as this investor gets closer to financial freedom, does it make sense to allocate part of the portfolio to dividend stocks based in the region where they're retiring? And I would say, reading into this question, really what this investor is probably worried about are currency fluctuations and also just unknowns about different countries around the world and what's going on. We know in recent years, just with trade wars and such, there's a lot of unknowns. With the pandemic, there's a lot of unknowns. And so I think this investor is basically asking the question, hey, does it make sense to have stocks in my native currency, probably for predictability reasons? And now I cannot answer questions, and I don't answer questions in terms of other people's situations, but I do speak hypothetically to my own situation. And I obviously know in my own situation, I take a lot of comfort in the fact that I have a lot of stocks in my native currency in the US dollar. And so fortunately, I don't have to be too concerned about currency fluctuations, although most of the companies I own do international business, and a lot of it, and a really founding principle and value my portfolio is having a globally diversified portfolio. So I guess I do have exposure to all the different currency fluctuations, but at the end of the day, I'm getting paid dividends in my native currency, so I don't have too much concern on it. Now, I'm just trying to put myself in the shoes that hypothetically, if I lived in Europe, or let's say I wanted to retire in Europe. Look, I love London. One day, maybe my wife and I retire in London. Who knows? It's possible. And so, boy, wouldn't that be cool? Anyway, would I change my strategy for that? It's so hard to say. I would generally say that I always prioritize quality over anything else. And so if I could find the best quality stocks in my native currency, yeah, that's a win-win. But if the best quality stocks are in another currency, another country, for me, I'm always a fan of quality over kind of worrying about currency fluctuations. And another way of putting this is kind of tax treatment. So many investors, money managers, finance people, I've seen this firsthand. They spend every waking hour trying to optimize their taxes or minimize their taxes, figure out taxes. Can I do this or that to nickel and dime and save on taxes here and there? Now, I don't want to put anyone down because I think that is prudent. It is smart to try to save money on taxes. But quite frankly, that's never a primary concern for me. The first concern is buying the best possible investments. Secondary concern is figuring out the tax consequences of it all. And so same with this. First guiding factor for me always is buying the best quality companies. Second underlying factor would be figuring out the currency fluctuations of it all. And now sometimes the first priority and the second priority, they align in lockstep and it all works out, but not always. And so I think it's really important to, for myself at least, to think of it that way. Moving on, check it out on the screen right now. This same patron asked another question, and he was basically asking, are you diversifying among different brokers? And the idea there is that brokers only have so much insurance. They only have so much SIPC insurance, and they only have so much extra insurance. And the concern is, what if something happened to a broker? Could I gain access to all my stocks? What if, aside from the insurance side of things, just something wacky technologically happened with the broker? Long story short, I am a fan of diversification in the sense of owning a lot of stocks. So I own 50 of them, 50 dividend stocks, but I am also a fan of diversification in terms of brokers. And so, yes, to answer this question, regardless of just underlying factors, I think it's always prudent to have more than one broker. And given a really large portfolio, it may make sense to bring in a third or even fourth broker, or maybe even more. It depends on the size of the portfolio. But having that redundancy, having that diversification, for me, at least, from my personal perspective, I think it's a wise and prudent move. And so I thought those were both really great questions. Thank you so much for your support on Patreon, my friend. Keep the questions coming. And now, before we leave today, don't forget to subscribe. It really means the world to me. This is Dividend Investing for Everyone. I hope you enjoyed the video today. In terms of full disclosure, I own the stocks mentioned today. I am long Otis, ticker symbol OTIS. I am long Carrier, ticker symbol CARR. I am long Raytheon Technologies, ticker symbol RTX. I am long Pfizer, ticker symbol PFE. I am long Viatris, ticker symbol VTRS. I am long Bitcoin, ticker symbol BTC. Oh boy, this is going to be a lot of disclosures. I am long PPL, ticker symbol PPL. I am long Altria, ticker symbol MO. I am long Philip Morris, ticker symbol PM. I am long BTI, ticker symbol BTI. I didn't discuss those, but they are in the handout that you can download in the description below. I am long Kimberly-Clark, ticker symbol KMB. I am long Coca-Cola, ticker symbol KO. I am long Johnson & Johnson, ticker symbol JNJ. I am long Starbucks, ticker symbol SBUX. I am long 3M, ticker symbol MMM. I am long PepsiCo, ticker symbol PEP. I am long Campbell's Soup Company, ticker symbol CPB. I am long General Mills, ticker symbol GIS. I am long Honeywell, ticker symbol HON. I am long Apple, ticker symbol AAPL. I am long Chubb, ticker symbol CB. Get in there. I am long Utz Brands, ticker symbol UTZ. I am long Hormel, ticker symbol HRL. I am long Church & Dwight, ticker symbol CHD. Those stocks I all own in my personal dividend stock portfolio. People ask why I do these disclosures. I do it to show you guys that I could potentially be biased in my analysis. I try not to be, but I own all of these stocks. And so subconsciously, at least, hey, you never know. And so I just want to be forthright with the stocks that I own with all of you. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed financial advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. Losing money in the stock market is a very big possibility. Please consult a financial advisor before you do anything. I am just sharing my journey here for fun. And with all of that, I love you all. I will see you in the next dividend investing video.